We know how much the inventory. The balance sheet. The balance sheet is one of the three main financial statements along with the income statement and the statement of cash flows. What the balance sheet is and what the balance sheet shows is this. It is a picture in a moment of time at a specific point in time. If you look at the header of the balance sheet, it says balance sheet, the name of the company, as of December 31st, as of March 31st, as of June 30th. It is at a point in time. It's not companies, and the statement of cash flows. What the income statement is doing is it's showing the results for the company. The income statement shows the results for a period of time. Normally when we think about the income statement, we think about a year, the annual income statement. But the company prepares the year ended. Statement at the beginning of the period, the account balances in these income statement accounts is zero. And then as revenue is earned during the period, that money goes into the revenue account. As things are sold, those costs go into cost of goods sold, salary expense, and all of those different expense accounts that the company has. But the thing about the income statement is it is a period in time. Now what we have here is a activity. And so the statement of cash flows is going to show. But right now as an overview, it's just showing where the cash comes from. Well, that's a question about whether or not those operations are going to be cash positive in the future or not. The statement of cash flows gives the reasons for the differences the company going to need. The exam is the indirect method. And the indirect method doesn't really show clearly how much are made with the owners of the company. So what we're talking about, these transactions with the owners of the company, the sale of shares, the payment of dividends. Okay, those transactions with the owners are not part of comprehensive income, but everything else that the company did some items that do not appear on the income statement because that is what the single statement with the income statement, or as two separate but consecutive statements, in which case we're just kind of drawing a line, we're breaking a little bit between statement of comprehensive income, that is other comprehensive income items. Now, with pension or other post-retirement benefits. Prior the statement of changes in owner's equity. This is the fifth of the financial statements. It's not one of the main three, but it's one of the five that we need to know. Statement of changes in owner's equity is a very descriptive name because what it's going to do is it's going to report the changes in each of those stockholders' equity accounts that are in the balance sheet as part of stockholders' equity and how they change during the period. This is also a reconciliation of the beginning balance in each period or each account with the ending balance. What we're just looking at is there was a beginning, what happened, what increased it, what decreased it, and what the ending balance is. So what we have here is a sample of this statement of changes in owner's equity. It starts with December 31st, year 1. It ends with December 31st, year 3. And we have each of the accounts going across the top. And then in each year we have net income, preferred dividends paid, common dividends paid, and the issuance of common stock as it happened in each of the periods. And so this is what we're looking at with the statement of changes in owner's equity. It's not a complicated statement. It's not a big statement. Very descriptive. The limitations of financial statements. Financial statements are the best source of information for users to make decisions about a company, but the information that's in the financial statements is not perfect. And so here we're looking at some of these limitations. We can't really overcome these limitations. The value of things are not in the financial statements. If it's not in this quantitative measure of money, it's not in the financial statements. But also, how we recorded that transaction 10 years ago may still be the way that the item is reported. Historically, what is called the going concern assumption, and this is sometimes what's not included in the financial statements. If we're aware of the limitations, we're better able to take that information and use it in the most effective and efficient way by looking at what we need to do to the financial statements to perhaps take into account some of these things that are not recorded in the financial statements. So it's not that